Hello, Matthew Copley here with a market update. Today we're going to cover some of the financial news out there and how it potentially impacts you. So a few headlines that are coming out. One is Apple on April 17th announced a new savings account. They're going to be offering a 4.15% savings account. You're going to be able to set this up within your Apple wallet. Super simple. I think this is going to be very attractive to a lot of people. So this is something that I think is a big change. And I think we may see this more and more from big corporations. I think a lot of people are nervous about the banking system and with what's going on with the banks. And I think that they may have more confidence in Apple than in one of their local bank. And so I think this will be a trend that will continue. And I think this may be a big change in the financial markets going forward. So that was a big announcement on finances. Another big headline the last week has been the CPI number. Came in lower than expected. So they said inflation was not as high as they expected it to be. It came in at 5%. This is down from the 6% that we previously had, and also down from the 9% that we were getting last summer. And so the expectations on Wall Street and the market analysts are thinking inflation is going to continue to trend down and maybe go down as low as 3% by the end of this year. Now, I don't think that's going to happen. I think inflation is going to continue to come in worse as we get towards the end of the year. What we saw with the CPI at 5% is a big drop in energy prices and used car prices that really took the index down. And I also believe that the numbers are not accurate. And I've got proof to back it up. In the CPI, it said that food came in 8.4% higher year over year. But we actually have data from Adobe, which is a software company. They actually scanned all of the food prices across the internet. This included, Costco and Walmart and Amazon Fresh and trillions of transactions. And they came up with food was actually up 10.3% in the last year. So we know that food prices are quite a bit higher. And some things we really noticed, like eggs, for example, were up over 29%. And so I believe that inflation is higher than they're telling us. I also believe it's going to continue to come in higher, and I think it could potentially pick up for a lot of reasons. There's a lot of things coming down, and I think that in June, July, when this whole debt ceiling debate starts to take full shape, I think this is going to be a real problem. It highlights to the rest of the world a potential problem with the US dollar and the financial system, and we don't need any more highlight on the US dollar and the debt and the problems. And unfortunately, I believe this is going to be a showdown. Typically what happens is one side wants something and another side wants something else, and they go down to the wire and they come up with a solution at the end. And of course everyone says that, the US government's not going to default on their debt, but there could be a potential shutdown, and you could see a period of time where things don't get paid, treasury interest and so on and so forth. And this is a real problem. It highlights already the nervousness that people have with the recent bank failures and just the overall market. So this is all going to be inflationary. People are going to be nervous. They're going to be going out trying to get their ducks in a row, making sure that they're in a good position for a potential problem coming this summer with the government shutdown potentially. And we're also noticing that real wages are substantially lower. And so this has been going on now. It is 24 months in a row. So 2 years solid, real wages have been dropping every single month. And what real wages are is the amount of income people get compared to inflation. So sometimes you'll see an article that says, oh, wages are up 2% and everything's great. Well, if inflation's up 5% and wages are up 2%, their real wages are down 3%. So we're seeing a big decline in real wages, and this is a problem for the economy. The data doesn't look good. People don't have as much money to spend, and more of their money is getting spent on the necessities. And this is why we're focused a lot on the investments in the stuff that people need. That's what I've been saying all along. People need to eat, they need to put gas in their car, but they don't need to upgrade to the iPhone 14. So when you start looking at the data, it's telling us that this problem is going to continue. And when Adobe tells us food prices are up 10.3% over the last year, that's a big number, double digit. And of course, we're seeing this kind of inflation all over the world, which is going to translate across the board. We're in a real global economy, and the US dollar is used all over the world. The United Kingdom just came in with their inflation numbers above 10% again. So this is a real problem. And so we want to really pay attention to what's going on in the market. And what's causing all of this? Well, it's the debt. There's just too much debt. The government is in too much debt. They're running extremely large deficits, and they're just spending money like a drunken sailor. They just don't get it. We're seeing really four things that are really impacting the deficits and the debt. The first thing is the government has to pay a lot more in interest on the current debt. It was that the government was paying, I remember back when it was less than $20 billion a quarter that the government was paying in interest on the debt. Now it's looking to be about $275 billion in a quarter. So it's a huge number. So the government has to pay a lot more interest on the treasury notes, and they don't have enough money in taxes to coming in to pay that. So that's a big expense that they have to add and tack on to the existing debt. Another big problem, probably the second biggest problem, is Ukraine. There is billions and billions of dollars that are coming out, going to Ukraine, and we're financing their government. We're financing all of the government workers, the pensions there in Ukraine, along with massive amounts of money for weapons to fight the war against Russia. And so Ukraine is obviously a big drain. Financial war is an inflationary issue. It's probably one of the most inflationary problems throughout history. So whenever you have war, inflation continues to be a problem. The third area that is a real issue is the omnibus bill that was passed last year in December. That still has not found its way through the economy. Lots of government spending, and so that is creating a problem. And finally, the last thing is Social Security. Everyone got an 8.7% increase in January, which increased everyone's Social Security checks. And now Social Security actually just announced that the insolvency for Social Security is going to, instead of be 2035, they're backing it up to 2032. Now, of course, this is all ridiculous. It's already insolvent at this point. They're paying out more money than they're taking in. This is just kind of like a government accounting that says that the government owes itself this money. But at the end of the day, it means that more money is going out for Social Security. There's not enough taxes to cover it. So there's all these problems with spending, way too much spending, not enough taxes coming in and to cover it. So this is going to continue to create debt problems, and these debt problems are going to trigger inflation. So I think inflation is going to be a lot worse than they're telling us. So we're going to stay the course on all of our investments. Obviously, the big thing to protect yourself from inflation historically has been gold and silver. The price of gold has gone up above $2,000 an ounce now, so we have seen some traction in that. We haven't seen a whole lot in the gold mining space yet. I think that the market still seems to think that gold prices are going to come back down. I don't think so. I think that eventually, the longer that it stays down and doesn't spike up, the bigger the jump's going to be when it finally moves. And we're seeing big accumulation of gold around the world. In fact, the central banks of the world are accumulating gold faster than any year. In fact, 2022, they accumulated more gold than any year since 1967. I mean, this is a huge amount of gold was being purchased by central banks around the world. So they got to know something, not to mention the central banks. A lot of very wealthy people are buying precious metals, gold and silver right now. A lot of the family offices are stockpiling. And it's interesting, a lot of these contracts on the COMEX are being taken as physical delivery. So this hasn't happened in years past. When a contract comes due, instead of just rolling contracts over, they're sending trucks into the COMEX and they're taking the physical metal, the physical silver, the physical gold. And when that's being drained down, it means there's less silver and gold in the marketplace to determine values, and it's going to have a big impact. And when there's less physical supply, if it's hidden somewhere that no one knows where it's at, it's in private hands, it creates distortions to the market, and it's going to cause prices to potentially really spike up. So obviously we're going to keep our precious metals positions on a lot heavier than we normally would do in a normal market. And so we have all those positions in place for our clients, and you're welcome to call and we can talk to you about that if that's something you're interested in taking a look at. But that is definitely a natural inflation hedge is precious metals, and we're focused on that. There's a lot of talk about the end of the dollar, de-dollarization. Clearly China and Russia are pushing very heavily to get us off the US dollar standard around the world. So they're coming up with their own system, the BRICS system. They want to have a commodities-backed currency. This is a problem for the US dollar. Now, I don't want to say that the dollar's over, it's hyperinflation, the whole bit. I know there's a lot of that on the internet that's being called out. You got to understand the United States dollar is simply the strongest, most liquid, deepest market in the world. It's used all over the world, and there's a ton of debt that's owed in dollars all over the world, and I just don't think all of those allies and partners are going to default all at once. So the US dollar is not going to have the big crash that a lot of these people on the internet are predicting. But it is going to be a slow decline, and you're going to see the dollar lose value over time. And clearly China and Russia are doing everything they can to get off the dollar system. And a lot of very important countries around the world have signaled that they are interested in working with China instead of the United States. Countries like Brazil and Saudi Arabia, and even France just came up with a new plan to work with China. So these are all concerning, and we definitely want to have our eyes open as far as the investments and what's going on. But I don't think it's into the world quite yet. One other thing I want to point out, obviously with guaranteed money, because we are concerned about recession, a lot of this bad data that we're seeing, tons of layoffs, and those layoffs don't hit right away, right? People get announced that they're going to be laid off, and then maybe in January, February, March, they get the announcements. They don't actually get laid off until April, May, June. They go on unemployment. They have severance packages. So we're not going to see a lot of this impact probably towards the end of the year is when we'll start seeing some of this impact on the layoffs. But it's clearly going to be a problem. There's recession indicators out there. So we got to weather through this. And obviously, one thing you can do is have some guaranteed interest, guaranteed accounts. We mentioned in previous videos about the MYGA, the MYGA. Great thing to put your money in. I do have some bad news. They did lower rates, and we thought that this might happen. And I think I mentioned in a previous video that I thought this would happen. The old 5.4% rate for 3 years is now 5%. Well, 5% is still pretty darn good. Get 5% for 3 years. There is no guarantee that that is going to continue. It is trending down now, so we could see lower and lower rates. It's interesting. You're seeing high rates on real short duration. I mean, even 5.5%, 5.75% for 1 year or 18 months. But unfortunately, there's a good chance at the end of that term that the rates really drop down, especially if we're in a really bad recession. So you're much better off locking in for a full 3 years if you can at 5%. So that's still available out there. And of course, we're going to continue to look at all the investments with the inflation perspective. And we encourage you to call us if you have any questions or want to talk about your accounts. We'll be happy to chat with you about your individual investment. One thing I do want to say, and I know it's a long video, but I have a little bit of a rant today that I thought I would mention to people. It's interesting. It kind of highlights what's going on in the world out there. And these are the new rules on mortgages and home buying and refinancing. So these new rules that go into effect on May 1st, this is going to impact people that want to buy a home or refinance a home. And they're going to actually charge higher fees. And this is the Biden administration announced this goes into effect. Anyone buying a house or refinancing after May 1st, these fees are going to amount to quite a bit. And the way it works is if your credit is 680 or higher, you actually have to pay higher fees for having good credit. And they're going to use those fees to help people with lower credit have lower interest on their mortgages. And the idea is you're going to help people that have lower credit, which is traditionally a lot of minority communities and things have lower credit scores. And so the idea is to help those people. But I think this is really bad policy. You're going to punish people that have high credit and give it to people with low credit. The government's incentivizing people to have bad credit. So the fees are going to be about, for a $400,000 loan, it's going to be about $40 a month, a little more than that. So it comes out to about $500 a year in extra fees, and it may not sound a lot, but on a 30-year mortgage, $500 a year, that's 15 grand in extra fees that someone's going to have to pay. And in order to avoid those fees, you have to have bad credit. And the other factor is coming in with too much of a down payment. So if you come in with more than 15% down, they're also going to have higher fees for you too. So really bad policy. This is the kind of stuff that we're seeing. And I'm seeing this obviously with the mortgage division, which we don't do a whole lot right now because rates are so high. But that's the kind of stuff legislatively that we're seeing out there. And all of these kind of things that they're doing, I think, is negative for business. It's going to hurt the economy. And at some point, maybe we'll get some common sense legislation out of the government, but at this point we're doing our best to weather through this as long as we can. So I hope that was a good update, and if you have any questions, feel free to reach out to our office. We'll be happy to chat with you.